All right, all right. It is Wednesday. Welcome, everyone. Thanks for joining Josh and I back with a Wednesday Night Live, answering your real estate questions, everything regarding finance, housing, tax credits. I'm sure that's going to come up tonight. Probably be talking about some capital gains as well. Josh will update us on interest rates. Josh, thanks for joining us.
Thanks for having us. We just need, if you could find like an extra 8 to 10 hours in a day to share with me, that would be ideal for us at the moment.
It's when it's that 4 hours that I get up before you. That's part of it. But
I
you
get those
gain it back
I
because you
get those
go
back.
to
I get
bed
the
4
4
hours
hours
after
after.
me.
Exactly.
No, awesome. So yeah, thanks for joining us here. We already got some people in the chat. Joey Cracks there. He was the first here today. I have to announce it, but it looks like he changed his gloves. You got to him
Thank God.
finally.
Thank God. No one wanted to see that anymore.
You finally got to him. But hey, guys, if you're watching, let us know where you're watching from. If you have a question, leave it. We will address it. Keep in mind the chat does start getting a little crazy there at times. So if we don't get to your question right away, we will work our way through it, or at least try to. Joey wants the EDDM music or EDM music back, not EDDM.
And then he didn't help us at all because there's still a Bronco in that picture. It appears as though the Bronco is getting lit up by two Packers. So I'm not sure why he would have put that as his little avatar, but
I can't even see that thing. I have no idea what's going on there.
I'm struggling. All I can tell is two Packers appear to be obliterating a Bronco, but he's advertising that for some reason.
Maybe he's a Packers fan now. You got to him. He changed.
We turned him.
No, but anyway, guys, put your questions there. Appreciate it, and we'll get to them. Josh, you want to start with you sent me an article this morning I thought was insightful on housing and everything around housing and what we've talked about with regards to inflation and house prices and bubbles and all that stuff. And at the end of the day, it's in line with what we've been talking about for the last year, for the most part. And not to toot our own horns or feed our own agendas, but it was good information that essentially, not clarified things that I wasn't sure of, but I think it provided insight on it. So, Josh, if you get an opportunity, maybe link that in the description there tonight and let people take a look at it. If you want in-depth analysis on somebody that's smarter than Josh and I, and networks with people that are higher level up with regards to mortgage finance and everything housing, it's good insight on what's happening in the housing market and what to expect probably over the next couple of years. But there was one thing in there that I thought was kind of crazy, and I had heard this story prior to this, but up in Citrus Heights, California, I believe, up near Sacramento, a property went on the market and over 2 days received 122 offers. It was a $400,000 property, 3-bedroom, 2-bath, I think 1,400 square feet, if I remember correctly. Crazy times. And this is, a lot of what we've talked about on here is similar stories like this. So if you have stuff like that, it's not to discourage people from buying, but it's good to know that, you're not the only one out there. If you're in this situation and you're getting outbid, you're not alone. Just stick to your plan. Don't get FOMO. Don't do dumb things in order to get your offer accepted, and things will work out.
Well, Jeb, I don't know if you picked up on it, but the first time I saw that story, it made me think of it, and then it made me think of it again here. It says the house received 122 offers in 2 days, including one above 500,000. Now, mind you, it's listed at 399.9,
right,
and has since been sold for an undisclosed amount, but it was reported the selling price was in the mid 400 range. So it's not always truly just an auction. Go to the highest bidder. Who knows why someone would offer up into the high fives or mid fives when the property's getting 100 offers in the fours? But the seller rightfully went through and said, who's going to be the best for my neighbors? Who's going to be the person I want in my house, the most likely to close, maybe the shortest close? Who knows what's in that offer? But it isn't always just a pure auction. I would say, Jeb, from your experience, how often does it truly go to the highest bidder? It's usually not. There's usually something funky why that person feels like they have to come in so much stronger than everyone else.
I don't know that I would disagree. I agree with that statement. I would slightly disagree in this market, just because I feel like sellers are looking at price first and then down payment second. So it's kind of a combination. And that's the only reason I know that is because, I always try to find out what the property sold for. So if my clients put in an offer, we don't get it accepted. Why? Why did you decide to go with another offer? Not that I'm not mad. I'm, whatever. Just tell me so I can tell my clients, because I think it's, if it sold for $1,000 more, then, that sucks. But if it sold with 20 offers and it sold for $50,000 more, while it sucks, at least my clients know that, hey, look, we weren't willing to do that. That's completely fine. And we're okay with where it went. So it's really hard to say in this market if it is the highest bidder, because obviously, I only know for sure with my own transactions, but based on what I've seen is that they've been countering, the top few offers, right? In most counter offers. So in I would say back in the day, a year ago, you put in an offer on a property and there were 5 or 10 other offers. Almost everybody would get a counter offer to some extent. But now, because so many people are offering on properties, it's, 122 offers. They didn't counter 122 offers in most cases. That would be, how much work that would involve. So they probably chose the top 10 maybe and countered those, the top 5 or whatever the number was. So again, to get back to your question, it's hard to say, but I definitely do think price is one of the top 2 things that they're looking at right now.
Oh, sorry, I went crazy there. I didn't think I was actually sharing it already. We'll go to that later. I was just queuing it up and it threw the info out there.
No. So we got some questions already that we're going to get to here. We've got banners. Hold on. We got to change this a little bit. I can't look at this. I don't know what happened here. I do not know what happened. Let's go back to default there. That's what I like. All right. So Theo.
Start with Theo and see if that helps.
Yeah, no, that does help. So Theo, comma zero. Anyhow, not sure if I read the article on the $15,000 tax credit refund, but it said you can collect it at purchase. Does that sound right? No. Tax credits typically get filed when you file your tax return. So if something like this were to pass in 2021, you would file it on your tax returns come next year. Most people, are W-2. I wouldn't say most people are W-2 employees, but for the majority of people out there, I think probably file W-2. It would be, you would get some sort of refund on your tax return based on that credit. Now, if you're self-employed and you pay taxes or whatever, it may just limit the amount you pay. It would come off that amount if it were a tax credit that were to go through. But right now, we don't know, right? It's just something that's been proposed. It's a bill. Still has to go to Congress to get voted on. There's a lot happening tonight with regards to President Biden and infrastructure talks and all this good stuff, and whether or not this will be included as part of that. Hard to say, but we'll probably know more in a week or so, or actually we'll know more tomorrow, to be completely honest. But the likelihood of something like this passing as is, I think, is going to be very, very difficult to get both sides to agree on unless it's part of a larger bill. What are your thoughts on that, Josh?
Yeah, it's the biggest thing to know right now is any tax credit is an expense to the government. So what he's talking about, what Biden is talking about tonight, is how they want to raise revenue. So the thought of passing something that's going to be another expense, and to what benefit? Right now, the housing market is on fire. Why would we want to put gasoline on that fire? At some point, it certainly could make sense. The way it's being pitched is really along the lines of Biden and Kamala Harris, their whole focus on equality. We're going to make it equal. If you look, we're going to help more people get into homes and own an asset, which a leveraged asset has been going up in price, and helping, in theory, increase equality. And that's a great goal. But at what cost? And how are you really helping people if it makes 10 times more offers or 2 times more offers than are already out there? And
We lost your audio there, bud. Can you guys hear me comment? I couldn't hear Josh. Lost Josh. his battery go dead on his headset there, his fancy headset?
No, my fancy headset does something that's brilliant. It allows you to connect to two sources, so my computer and my cell phone. And when the phone rings, even if it's on silent, it comes up and takes over the audio and silences the other one.
So we lost the last bit of that, but basically talking about raising taxes and all that good stuff. So, there's some interesting things that are going to be proposed tonight. One is, potentially changing the way capital gains are taxed for investors over $500,000. And why this is important is because if you start changing the dynamics of how commercial real estate is taxed on capital gains, you're going to have investors likely moving their money out of expensive commercial property, probably into residential, where they can move it around a little easier and be able to not get hit as hard in some cases. So it's going to be interesting to see how this whole thing plays out. And if that were to happen along with a tax credit, what does that mean for the housing market? I have no idea. So,
well, the
anyway.
capital gain stuff, Jeb, if it were to pass, people have talked about, hey, people may be selling equities and stocks to harvest some gains prior to this increase in capital gains. You could see some people doing the same thing.
Absolutely.
With homes. Homes have appreciated greatly. If you think they're going to level out, or even if you just want to take the gains, it might bring some supply to the market. For the most part, if you look at what's been proposed, it's all not great ideas. We need to raise taxes. And that's like, it's funny, this always devolves into a partisan thing. I was on a conversation, a Zoom call with some thought leaders in the housing industry today, and we're talking like, about 20 years ago, it used to be that Republicans were the party of fiscal conservatism, so they didn't want to spend and they wanted to keep taxes low. Well, about 20 years ago, they joined the Democrats in agreeing that we should spend. So an easy way to get reelected is to spend money. Everyone has a pet project, something that we can give away. So both parties started giving money away. And now we still have Republicans holding on to, well, no, we're low tax or anti-tax. We don't want to raise taxes. We've gotten to the point, you guys have heard me say this before, Obama comes into office, $7 trillion federal debt. When Biden leaves office, we're going to be over $30 trillion federal debt. There is no choice, regardless of your political ideology, that you don't want more taxes. We have to have higher taxes. So they're coming, regardless of who is there. I don't like the way it's proposed here and the way it's being pitched to America of saying, hey, we can tax the rich, which no one defines themselves as rich. I've yet to come across a person that goes, I'm rich. So if you say we're going to tax the rich, it's always, well, that's cool. That's not me. We got to raise taxes. Let's make sure it's not me. The reality is, if we taxed the 1%, took 100% of their income every year, we wouldn't put a dent in the national debt. So let's be realistic about this. It's coming to the non-1 percenters. So if you're at the 90th percentile, you're at the 80th percentile. Realistically, if you're anywhere above the 50th percentile, you're going to pay higher taxes because we've spent way more money than what we have.
All right. No, good stuff. And I'm sure we're going to have some more questions on this, as because he's starting to talk at 6:00. So hopefully you guys stick around with us and not him.
Not that old gray boring guy.
Yeah, exactly. Because it's going to take about an hour for him to actually get into what he's saying. So Joey came back and he changed his avatar here. That's going to pop up, and I'm actually going to be able to see what that is in just a moment here. But anyway, so yeah, he's got a Bronco. There's 3 Packers on him, so he's getting creamed.
Michael, I'm sure if you go back, that's an important moment to a Bronco fan. To everyone else, it's just John Elway getting killed by two Packers.
So Texas market seeing huge delays in concrete and building supplies, huge lead times. Yeah, I was reading some articles today that I think the average cost of a home has gone up about $37,000 with regards to construction costs, just because of where lumber is. In fact, in that article that Josh, I don't know if you posted it, Josh, or not, but he talks about, at one point buying a sheet of plywood, 4x8 sheet of plywood for $8 or something. And now it's $87 for the same sheet of plywood, which is absolutely incredible. So,
Jeb,
go ahead.
Take a look at this. This was the chart that blew my mind. So the plywood story is right here, but this is the chart. So this was like right prior to COVID. It's an index of lumber costs. So don't look at that as a dollar value, but it went from 300, spiked up to over 900, almost 1,000. back down. I don't know how in the heck that happened, and then shot back up here again. So what I can say is that 300 to 1100, this isn't the real nut price for lumber. It's going to moderate at some point. Now, does it settle back in somewhere in this range, in the $500-600 range, or do we get back down in this low end of it? But it's going to moderate. You know, one of the questions someone had in here was people saying the real estate market's going to settle down. What does that mean? It doesn't mean that if we looked at the chart of real estate, we're going back down here to the lows. It just means we're kind of crazy. It'll moderate in terms of volume, meaning you know, sellers to available properties to the number of buyers. But I just thought this was important to kind of show the chart where you can see that this is insane. This is temporary. I don't know if it lasts for 2 more months or 12 more months, but at some point we're going to come back down into a more reasonable level.
Right. Yeah. No, the distribution chains have to change, right? You can't continue at the pace that we're continuing. But at the same time, I mean, we live here in Huntington Beach. For those of you who don't know, right on the beach, right? So we look off the coast. And when we look off the coast, we see the boats, the ships, the container ships, like the one that was stuck in the Suez Canal. Yeah. Anyway, that come into Long Beach and the Los Angeles ports. And, on any given day, you look out there now, there's 40 of those things, just 40 large container ships. I mean, these things are massive and they're stuck because they can't get into the port because the port is backlogged. It's backlogged because of COVID. Primarily, there's not enough workers. There's not enough to unload the ships. There's not enough workers to drive the trucks to, distribute this stuff. It's just this whole issue. And it's, and all it takes is one backup to create more backups. And it's going to take a long time for us to get out of that little supply issue there. But once it does regulate, things will probably start to ease a little bit. Now, I don't know if that helps on the lumber side as well, but just in general, you'll see cost likely moderate a little bit because in most industries right now, you're paying more for supplies, you're paying more for things than you did 6 months ago. And it's not because of permanent like inflation. It's just a temporary hiccup, in my opinion, of what's going on with supply chains. So
it's not that there's less trees out there to harvest the lumber. It's there was an issue with some sort of infestation. So there's technically less lumber, and then getting the lumber to market, and then high demand because builders are building a lot of homes. For those that didn't suffer from COVID, there's a ton of construction going on. So there's high demand for lumber, a limit in supply, both because of that bug and then the issues of getting it to the market.
No, absolutely. So Klar has a question for us, $5 super chat. Thank you, Klar, for that. Is it good to refinance from conventional to cash out FHA or refinance from conventional to conventional with the same rate, but remove PMI and cash out? Josh, thoughts there? I know there's a lot going on, but answer the best you can.
Yeah, absolutely. Go back to numbers never lie. So if you're my customer, we're going to put this in a side-by-side comparison. Here's what the FHA looks like. Here's what the conventional looks like. Here's the pros of FHA. Here's the cons. Here's the pros of conventional. Here's the cons. So let's break it down in simple terms. You already know with the FHA, you have the mortgage insurance. It's 0.85%. So you're probably going to get an amazing rate on that FHA loan, but we got to add 0.85% of that because you're going to have the mortgage insurance and it's on there for the life of the loan until you refinance again. The conventional loan, especially cash out, is going to have a higher interest rate, probably at least 0.5% higher, but you're not going to have the mortgage insurance there. So if we're 0.85 less on the MI, but somewhere 1/2 to 3/4 higher on the interest rate, probably going to have a similar payment. I would bet it's going to be a little bit lower on the conventional loan from that perspective. And the benefit of it is it's all in interest and not in mortgage insurance, which may or may not be tax deductible, but for the most part is not tax deductible.
No, there you go. Good stuff. All right. So let's go back up here and address a couple of these questions that we had coming in. Bear with me. Here, I'm going to just hit this one because this one's easy to answer. Josh, how long is a pre-approval good for before having to re-verify information? Got Surf City HB. So that's coming from Huntington Beach.
they might be local to us. So what I tell everyone is the different documents in the file age at different timelines. So we need pay stubs within 30 days. So after 30 days, you're going to have to update those. But if you know nothing changed with your income or employment, we're not going to keep updating it while you're out finding properties. We're going to update it once you actually get something in process, unless your qualifications are really borderline and we want to just keep an eye on it. Bank statements, again, you're going to be okay for about 30 days. Your credit report for 120 days from the time we pull it. And that's from 120 days. We have to close within 120 days of pulling that credit report. So really, those are the big things that we're looking at: assets, income, and the credit report. So for the most part, things are taking a while. We have part of why when we started the show, I'm talking about how busy I am. It's not that we have so many more loans. It's that someone doesn't get pre-approved and then find a home in 10 days and then we're moving on. They're just backing up because people are having to look for homes for 30 days or 45 days. So it's not uncommon that we're updating documentation. But for the most part, we had a couple clients get properties in escrow last week that we're 2 months out of date. We just got updated bank statements, updated pay stubs, and we were fine. So it's not something really to worry about. The big question I always get people ask is, how long is my pre-approval good for? Well, it's good for as long as nothing changes in your profile. As long as you didn't go buy a new car, as long as you didn't miss a payment and your credit score drop, lose your job, or get a pay cut. Or go and spend the money that you had in your bank account. So as long as nothing changes in the underlying qualifications, it's not so much to worry about something aging out. We just collect new documents and move on.
All right. Good stuff. Michelle Kim's got a question here. Also a $10 super chat. So thank you, Michelle. I found an off-market home, FSBO, so for sale by owner, for those of you who don't know, that explicitly says no buyer agent commission will be paid. As a first-time home buyer, I would feel uncomfortable doing this alone. Any advice on how to proceed? So you're right to feel uncomfortable doing it alone, and you shouldn't do it alone. It's one of those things that, this is hard to navigate, because if you have a for sale by owner that is truly willing not to buy it, not to give in, it's going to be a tough. If they're already negotiating you that tough on like the basics of a commission, paying a commission, and depending on the purchase price, we're talking, as little as probably 2% that could go to a buyer's agent on something like this. Just think of how you're probably going to get negotiated on repairs and that sort of thing. And when you don't have agents involved, not that you have a lack of transparency, but you have a lack of required documentation that is crucial for any buyer buying a house to see. Depending on what state you're in. Here in California, for example, very litigious state. There's a lot of documentation, a lot of I's that need to be dotted, T's need to be crossed. And so having an agent represent you is important. And I would go as far as to say, having, if you couldn't have a buyer's agent, having the listing agent represent you to some capacity would be your second best option. But chances are there's no agents involved here. I don't know that I have an answer for you other than, if it's a property you're interested in, you've seen it, have an agent write a contract on your behalf with some sort of compensation agreement and send it over to the seller and see how they respond. They might say, we're not willing to do this. And then, it's up to you and a buyer to decide. Your other option, and I'm not necessarily recommending this, is you can pay an agent to help you, right? So if the seller is not willing to pay an agent to represent you, you could come out and you could say, hey, listen, I'd like you to represent me, Jeb. The seller's not going to pay you, but I'm willing to give you X amount to represent me on this transaction. I've already found the property. I know I want to buy it. I just need you to, make sure I'm not getting bamboozled, if you will, make sure I'm going through and doing the right things. And chances are you can probably find a good agent that would do that and guide you through the process. Anything you want to add to that, Josh?
No, I'm going to throw a very broad generalization out there, so always beware of anyone throwing broad generalizations. But a FSBO seller generally falls under the umbrella of, I know everything and I don't need to pay anyone for anything. That's generally a hard person to negotiate with. If you're an experienced investor or you've owned multiple homes and you negotiate for a living, you might be comfortable stepping into that. But as a first-time buyer, you're right to beware. What they're essentially saying is, do what you want. I'm not paying for it. So as Jeb said, have them write an offer with an additional X of compensation in there for them and hope the property appraises and it can be included. Or offer to pay them out of pocket. Find an agent you say, hey, I'm trying to get this under contract. I want you to review the contract and make sure I'm not getting taken advantage of. But just know the general personality type of a for sale by owner seller. They think they've got it all figured out. No one else is worth anything, and they're willing to negotiate and pretty hard. So just be careful. I wouldn't shy away from it. Whatever it takes to get a property under contract in this market, just be aware that there's more risk in that for you, which you already are. You wouldn't have asked the question.
No. So hopefully that helps you out a little bit, Michelle. And again, thanks for the super chat. So Dane came in earlier, ask a question here. I think Dane might be a mortgage guy. I can't remember exactly, but in 2 years, looking to sell my home in East Orange when my kids are a little older. If I do a jumbo loan, can my wife only show 1 year of tax returns? Do you know any programs? And he goes on to say, and by the way, I'm using you, Josh.
So he must not be a mortgage guy.
Must not, or doesn't have access to those types of programs. Why? Well, I'm sure we'll find out, but go ahead.
So yes, we do have a couple of options that will follow DU findings, including 1 year tax return. So we still have to get the DU findings. And I say DU because you also have Freddie Mac's automated underwriting engine, which is Loan Product Advisor. But most of the jumbo products that will follow an automated underwriting approval will default to DU versus LPA. So yes, we do have an option for that, and they lend in all 50 states. So any of you that are anywhere else, we can absolutely get you connected with someone who can offer that if you're looking for a 1 year tax return product on a jumbo loan. There you go.
Hopefully that helps you there, Dane. So Joey Cragg, one of our regulars here. Thanks for joining us, Joey. Has got a question, a $10 super chat. So thank you again, Joey. We've worked our way up to a case of 805 for Josh. He's going to be thrilled. But anyway, he says, gents, is there a way to model or a tool to estimate what my pre-approval would be without hitting my credit? I know pre-quals are trash and trying to gauge when to execute. Measure twice, cut once.
That's the right philosophy. I like the hashtag. So the answer would be to do a soft pull on the credit. We have access to a soft pull. Most reputable lenders should have access to a soft pull. And what it means is we're not going to get the exact credit score like we would if we were to pull it, but it doesn't show as an inquiry on your credit report. The follow-up I would have to that is most people panic or worry about too many inquiries. Unless you know that you're going to have to be pulling credit for 14 different purposes. Let's say, hey, I know I need a new credit card and I need a new line of credit and I need an auto and I'm looking to get a mortgage and all four of those are going to pull. I wouldn't worry about it. The modeling doesn't love a bunch of inquiries showing that you're pursuing credit in multiple places. But for the most part, a single hit is going to be 1 to 3 points negative hit to your credit score. So if you're someone that has a 780 credit score, who cares? If you're someone that has a 750 score, you probably don't care. The people that tend to have a little bit of a bigger hit and may worry is if you're just struggling to get above a 680 or a 640 that on those FHA loans we know is important, you might want to be careful with it. But long way of saying, yes, you can do a soft pull. It should show us all of the debts, and we will always confirm that with you. Hey, is there anything that's not showing here? Because generally the soft pulls are a single bureau instead of a 3 bureau. Most major credit accounts will report to all 3 bureaus, but some of them will only report to 1 or 2. So you just want to make sure if someone is pre-approving you based off of a soft pull, know that that's not the guaranteed credit score. It's only one of the 3, and it may not be as exact as the full credit report. But don't hesitate to have your credit pulled. It's worth the small hit to the credit score is worth the certainty that it provides.
There you go. I want to get back to Michelle's question here because she did a super chat and she asked a question and she asked a follow-up question that I want to address here. So what is appropriate compensation if I'm paying my own agent? So, understand, Michelle, there's no standard commission in the real estate industry. Each seller, it decides and agent decides on what the commission will be. So there's not really a standard set commission, and it's I would say it's probably, depending on the purchase price that you're looking in, would be a reasonable compensation. But I would think, have a conversation with the agent that you're looking with and find out. I mean, they might be willing to do it for less than the number that you were thinking. That's the way to negotiate, right? Have the number in your head, find out what somebody is willing to do, and maybe it's less than what you're willing to pay, and then you can just go with that. But I would say, I don't know, that this is a hard question to answer. I mean, if they're just doing paperwork, they're not, out showing you property and doing that, I think you could probably get away with maybe 1% of the purchase price in many cases, depending on that purchase price. So hard question to answer without knowing all the details. Go ahead, Josh.
Michelle's in LA. It's a good solid price. I think an agent probably would, without having to drive you around show, probably would be happy to represent you for 1%. But Michelle, give me a call. We can go through this. So I'm not a practicing realtor like Jeb is all day. I'm a licensed broker. I've represented myself in over 60 real estate transactions. So we might be able to give you the comfort of overlooking things and telling you what you should be looking for, without having to look at any additional cost from that perspective. So we've already got all your info. Give me a call either when we get done tonight or tomorrow, and we can go through it and kind of tell you if that's the property and we can make it work. We might be able to get you the certainty that you need to feel comfortable moving forward.
There you go. Sean's got an interesting scenario here. Went to show a property today where the realtor had all the showings scheduled for the exact same time. Dozens were lined up to go through the home. The HOA president was out yelling at him, wondering what was going on. So that is, dumb on many levels. One, primarily on the agent's level who did all the scheduling, to have that many people at a property at the same time, regardless of an HOA or not. It just adds to the frenzy of what's already going on in the housing market. It's, showing up to a property and having to wait in line for however long to see a property is absurd. And it creates this whole, again, it just adds to that frenzy that I think most people just need to back away from and not get sucked into, because it just adds fuel to the fire. We got James watching from Battleground, Washington. We got Joe in Hesperia. Gladys moved to Sun City West, Arizona from LA. Let's see here. Joey came in and said that's the famous Elway helicopter play.
Famous only to Bronco fans, to no one else. I'm just teasing him. I knew what it was. I just wanted to irritate him.
No. So Gerald is watching from Irvine's, already in his purchase agreement, but he's waiting for construction to be complete, wondering why he's still here. Because you're a loyal fan, Gerald, and we appreciate it. So thank you for joining us. Here's the article. So you guys scroll up a little bit depending on where you joined. Copy that and take a look at it. I think it's worth the read. It's a 5-minute read for most people out there, and I think it provides a lot of insight on the housing market. So check that out.
Let me throw it for those of you that are interested and do want to read. I'm going to throw this in here. There's a bunch of really good charts in there, but where I feel don't get me wrong. So Jeb talked about how smart John Malden is. One of the smartest dudes, the guy that writes this newsletter. He's one of the smartest guys, and primarily really smart because he has a team of recently minted MBAs that he hires that read everything. They summarize it for him, bring it to him, and if it's important enough, he reads it also. So he's probably the most well-read guy. He's not just smart, he's also very well-read. But doesn't mean he doesn't have blind spots when it comes to an industry that may not be his wheelhouse. So one of the things he's showing here is ratio of home prices to average hourly earnings and how it's kind of creeping back up here. And then home price to rent ratio also at a high, home price to CPI. So we could go through all of these, but the easiest one here is home price to average hourly earnings. Why are we getting higher? Because interest rates keep moving lower. And as long as interest rates are lower, a household can put more of their, they get more bang for their buck because the higher home price costs less in terms of a payment. I can't stress this enough. As long as interest rates stay low, and I'm of the camp that they're going to stay low forever because the government doesn't have the option, they can either default or they can manipulate rates lower even than where they are right now. As long as we have that, this is much less concerning. If something were to happen where the government was comfortable defaulting on their debt and rates could normalize, then yeah, we would have home prices come down, because with a 4.5–5% interest rate, we would be up here near the top of where that chart is of showing home prices to average hourly earnings. So it is really good info. Malden is on top of it. He goes through why he doesn't think there is a housing bubble, and it will likely continue. So by all means, definitely give it a read.
There you go. So Darren just put in his first offer on a house, got it accepted for $5,000 under the asking price, qualified for Bank of America's down payment and closing cost grant, got $12K. So congrats, Darren. Bank of America's grant, you got to be in specific zip codes. It's based on certain things there. So we could talk about that in more detail at another time. Ali. Is it a good idea to wait for foreclosures to start popping up? I'm a first-time home buyer looking for a duplex. So here's what I would say. Think of you wanting to buy a duplex. Think of how much demand there is in the market, and think if a foreclosure comes to the market, hypothetically, and let's just say that foreclosure actually comes on the market for less than it's worth. What do you think's going to happen with all of that demand? That demand is immediately going to go for a property that's discounted, right? I mean, people are looking for discounted properties. Investors are looking for discounted properties. Everybody wants a discounted property. But the reality is, most people know in this market that if they price a property somewhere near fair market value, it's likely going to sell for that or even higher. So the chances of a foreclosure coming on the market and you getting a deal on it with demand this high, I don't think is very high. So I would encourage you to, it's okay to look at foreclosures, but I wouldn't sit here wait thinking that you're going to get a deal if a foreclosure comes to the market, just because I don't think you're going to one day wake up and there's all these foreclosures on the market, right? It takes time for these things to hit and trickle to the market. Plus that you're going to have competition. Josh, what's your thoughts on the question?
Yeah,
there?
you're dead on. Price is a function of supply and demand. We have way more demand than supply, and we're not going to get enough foreclosures that magically now we're inundated in supply. What I will say is, from 2008 to 2011, I bought 35, 40 foreclosures, and the ones that we got discounts on, even in that market, every foreclosure was going at a discount because there were so many of them on the market. But the ones that we could invest in and buy were the ones that were not financeable. So if a destroyed foreclosure comes on the market and it can't be financed, so that most buyers cannot buy it, it might go at a discount. But even at that, we're seeing so many investors out in the market with cash that it would still probably not go at much of a discount, just because of the demand even for those properties. People make the mistake of thinking that short sales and foreclosures magically go for less. They don't go for less. They're prevalent in a market that is depressed and does not have a lot of demand and has plenty of supply. So they go for even less than the home that is offered by a real seller.
Right. So if you had a lot of supply out there and not a lot of buyers, then yeah, typically you could get a discount on a foreclosure. But in a market like this, where you're operating less than 2 months supply in most markets, any foreclosures coming to the market are likely not going to benefit buyers at the moment. Anyhow, John Ziad, Lakewood, California. Thanks for watching, John. So James, primarily only very well qualified buyers are winning houses right now. Will this deplete highly qualified buyers? Will this have any long-term effects? Josh, what are your thoughts on that?
There's certainly logic to it. Right now, there's no limit to those really well qualified buyers, and I say that I was just looking through. We don't have a ton of people. Maybe this is why they're not getting offers accepted. I don't have a ton of people coming through with 30 and 40% down, or with the really low debt to income ratio. I have a lot of people with good credit scores, good incomes, good jobs, but no one that you would go, oh, this is no brainer. If they make the highest offer, I'm going to give them this home. But there's certainly logic to it, but there's so few homes selling that we're not dissipating that supply of well-qualified buyers. And really, what are we talking about? You just go from the people that are super well qualified with big down payments to people that are super well qualified with lesser down payments.
Right. Yeah. No, a difficult question to answer in the moment. I mean, when you've got, like, for example, we talked about that story at the beginning of the show, 122 offers on a property. I'm thinking 122 people made offers. 122 were likely qualified to buy that house. So, I mean, that means in theory, 121 more houses could come up at that price in that market, and you would still have qualified buyers. So it's a difficult question to answer because it's, we're not seeing a lack of people out there willing or able or, in a position to buy. So I think until you start to see that slow down, you're not going to see much of change on that front. Let's see here.
We had a couple questions here, good ones from Al Bundy here. Al Bundy throws up, hey, Josh, you mentioned that direct lenders charge $1,000 to $2,000 of additional lender fees. Where would a buyer see this on a loan estimate? And just want to confirm, it's not 100% across the board. I do see direct lenders come across, and they've done the smart thing of making it simple and easy for a buyer to understand, and just realizing, hey, whatever the rate is, there's a value in that when we sell the loan, and that's enough of our profit. We don't have to nickel and dime. But for the most part, the direct lenders, 70-80% of them are going to have those. When you look at your loan estimate, everything in box A is paid to the lender. So discount points to manipulate the interest rate lower, and any underwriting fee, admin fee, loan doc fee, those items in box A are paid directly to the lender. And most importantly, they cannot vary. There is zero tolerance item. Once they send you a loan estimate, other than discount points, if your loan estimate in the top right corner said that the loan is not locked, discount points can vary until it's locked and then cannot vary. But everything else in box A, there's zero tolerance. It cannot change from when it's initially disclosed to you. So look in box A, and there's sort of an important follow-up to that. On a purchase, you really only need to shop interest rate in box A. I get people asking me all the time, well, what's the APR? What's your APR? APR is not meaningful. It's not something that's going to help you shop for a loan. Because again, everything outside of box A on a purchase transaction is going to be the same no matter what lender you use. You talk to 10 lenders, escrow and title are going to get determined in the contract. 99% of the time, the seller is going to pick it or their agent's going to pick it. And even if you do pick it, again, it's your choice and it's going to be the same regardless of what lender you choose. The lender is not going to. All of your prepaids to set up your escrow and impound account, your recording fees, your homeowner's insurance, going to be your choice. Those things are not going to vary. So on a purchase, box A is the only thing you need to shop, box A and interest rate. So if I say it's 3% and 0 in box A and someone else tells you it's 3% and $2,000 in box A, then you know our deal is better from that perspective, assuming two equal loan officers and that you're happy with the service and experience levels from both of them. Where it does vary, if you're looking to refinance, on refinances, I do get to pick escrow and title. So I control the things in all of the other boxes, not recording and not your homeowner's insurance, but the things that you would shop for. And if you want to shop around and tell me, hey, I found an escrow and title company, they're going to do it for free. Cool. Let us know, and we can do that. So other things being equal, on a refinance, you do need to look at third-party charges as well to determine what the total cost of the loan and whose options are best. And then Al, I'm not 100% sure your follow-up question here is how much do loan extensions cost? And I think you're asking, is it the same as a rate lock extension? That's really the only thing that would need to be extended. We can keep a loan open forever. The lock is an actual commitment, and if it's going to expire, we do need to extend that with our investor. And a direct lender, they're still going to sell that loan, and they're going to make that forward commitment on that loan, and they're going to have to extend it as well. So for the most part, you're looking at 1 to 2 basis points a day. So let's say that if you needed 10 days and the lender is charging 1 basis point, that's 10 basis points or 1/10 of 1 point. So a $500,000 loan, it would be $500 to get that 10-day extension. It might be $1,000, but that's as good as we can do with the math here. We don't have our cool whiteboards to throw that up for you.
All right. So hopefully that helped you there, Al. Radiant Kratos has been on here before, another super chat. So thank you, Radiant Kratos, for that. Wife makes about $32K on her W-2s, but gets around $13K in mileage reimbursements for a total of $45,000. Can she qualify all $45K, or does the underwriter have to default to the $32,000 on the W-2? Josh.
So every loan program handles this differently. A mileage reimbursement, it comes back to, again, it varies from the type of loan program that you're looking at. If you're taxed on it, we should be able to use it as income. If it's not taxed, we might be able to offset a vehicle expense with it. But Fannie, Freddie, FHA, they all treat it semi-differently. So if you want a dead-on accurate answer to that, shoot me an email, just josh@bywisemortgage.com, and let me know if you're looking at conventional or FHA, and I'll dig in and get you the accurate answer as to exactly how it could possibly be used.
There you go. Got a couple things happening here. Joey Crack is a member now. Joey, thanks for joining the channel. And also has a question with a super chat. And thanks for doing that. $10 super chat. Follow up. What is the all-in minimum amount of money, down payments, closing costs, etc. lenders want in the bank when underwriting for, say, let's say a $600,000 to $800,000 house? So depends on the loan, right?
Yeah, it depends on the loan and whether the loan program requires reserves. So for us in Southern California, even an $800,000 house, we can do Fannie, Freddie, FHA in Orange and LA counties. Some other counties we can't. But assuming it can go under Fannie, Freddie guidelines, most of the time we don't need reserves. So the question is, in simplest terms, you would have to have your down payment, and that's it. We can get a lender credit or a seller credit to cover everything else. You would just have to have your down payment. So an $800,000 house, 5% down, you'd need $40,000, but you would need to come up with the funds to cover your closing costs and prepaids one way or the other. We can do it in a lender credit. You can get it from a seller credit. You can get it in a gift. So those programs don't require reserves. Most jumbo loans, though not all, we're getting more of them that follow Fannie Freddie guidelines day by day. But a lot of jumbo loans do require reserves, or if you owned multiple rental properties, you might need reserves. And those are generally determined by the automated underwriting system. We set everything up, put all your facts and information in there, run it through, and it will come back and tell us exactly what you need in reserves. But for the most part, the easy answer is as simple as your down payment is the minimum that you need.
All right. So got a question here from Michael Ocean I want to throw up. I think it's a good question based on some of the stories that we've heard out there. The house I'm interested in currently has tenants, has a lease ending next month with eviction moratorium. How do I protect myself from the tenants not leaving when their lease ends? So what I would tell you is that you want those tenants out of that property prior to you closing on it. Would be my recommendation if there's a way to make that happen. So typically speaking, you've got, the close of escrow date out there. It says you're interested in, so I'm assuming you're not in escrow at the moment, but if you are, make that part of your agreement, right? That you need the property vacant upon receiving the keys on that property, and don't allow the close of escrow to happen until that takes place, because otherwise you could be in a position where you close on a property, the tenants stay in that property, and then it's your expense, right? Your expense to get them out of the property, which could result in, you having to evict them, and cost and all that good stuff involved. Now, in the case that the owners live in the property and, they're doing a short-term rent back because their property's not ready or they're moving out of state or whatever, that's normal. That I wouldn't be concerned with. That happens all the time. The case that we're talking about here and how this comes up is in Riverside County here in Southern California. There was a gentleman that sold a property back in January, I think, or February of 2020, sold the property all cash, closed on it, and then decided not to leave the property. So then you had all the moratoriums in place, and that guy's been in the property now for, I think, 14 or 15 months. So protect yourself out there. Just, the best thing to do is just make sure they're out, and then you don't have any concerns.
And it's an interesting one. There is a misconception. The moratoriums are generally for tenants who have been adversely affected by COVID. If you have someone who hasn't lost their job, and the reason why I know this, my wife is in the mortgage business also, and she's working on a deal for a client of theirs that it's a tenant occupied property. It's a fourplex, and the occupant of one of those 4 units is not giving access to the appraiser, just being a pain in the butt. and they're trying to do the eviction process because he's not cooperating and following the terms of his lease. You give a tenant 24 hours notice, you're allowed to access the property, and he's just being difficult on that. So long way of saying, you can evict, but Jeb's 1,000% correct. I would just steer clear of the potential headaches.
Yeah, no, for sure. I mean, there's definitely some way, and if you're outside of California, probably easier to do. California is a pain in the ass, so you don't want to go there if you don't have to. Richard, I'm kind of going back down the questions, guys. So for those of you just tuning in now, we had a lot of questions come in, had some super chats, so we've kind of got out of order. I'm trying to get back up to the top where people started putting in questions, and I will work my way down as we get there. So thanks for hanging in there. I'm not avoiding anyone, just trying to make sure we're getting everyone taken care of. And if you find value in this show, you're here, do us a favor, hit the like button. That helps. It helps more people get the content. And if you find value in it, chances are other people do too. So Richard Pandy, he likes to ride motorcycles and listen to us. Listening in, and always appreciate the content, hoping the inventory picks up, is the last 2 properties I put in sold for $90,000 over the asking price. So he's here in Southern California, I believe. Yeah, but not crazy. I mean, at one point I thought that was crazy. Now I think it's just normal. But he's not on his motorcycle today, so that's good stuff. Scrolling down a little bit here. Sean, who made a comment earlier, also mentioned, Josh had made a question earlier about how often does the highest offer not get accepted. Here's a case where, he was over the asking price by 14%. He lost to a lower bid that had a higher down payment. So in this case, the highest offer didn't necessarily win. The person with the stronger down payment did. So, that's why when you're making these offers out there, people, you've got to make sure you're covering your basis on all sides. And if you don't have the potential to put 40% down, then, unfortunately, there's nothing you can do there. You just got to present your best offer. And if it doesn't get accepted, it's a lot easier for me to say than the people going through it. But you just gotta move on, right? You couldn't have competed in that case anyway.
And I don't want to divulge Sean's financial information here, but to say I talked to the agent last night, right before they were ready to present the offers. We had a good conversation. He had reached out to everyone's lender of the ones they were actually considering. And I felt like we had a good chance. I didn't feel like any guarantee. So it's interesting to see that it was down to the final 2. And what I will say is the agent, Nicole, that Jeb hooked Sean up with, did a very good job, presented it perfectly, gave him all the information. We followed up. So just, again, I think all of that extra work goes a long ways towards getting you into the final 2 here. Sean being really strongly qualified is also get you into that last round of bidding, but it doesn't guarantee you. So again, we've talked about this before. We do it on every file. Your realtor should do it on every file, every offer. We're just, you don't know which one's going to go. You put your best foot forward and let the chips fall where they may.
Right. No, yeah, you can't, again, I said it, misery loves company, but it's one of those things that, just understand there's a lot of people out there in the same position. You're not the only one if you're putting in offers, not getting them accepted, and it takes multiple properties. I mean, you guys heard me talk last week and did a video on it this week, 20 offers for one client to get one accepted. Now that's excessive, but you can see, there's a lot of people putting in multiple offers that have good credit scores, that have, decent down payments and still not making headway.
Hey, Jeb, unless you have one, I got one for you I think you're going to like.
Oh, let's see it.
So Noir 101 says, my agent says I can waive the inspection on my offers on properties that have HOAs because the HOA already covers the structure. Do you think this is a valid reason to waive your inspection?
I would say find a new agent. Is how I would answer that question. That's as clear as I can be on that. HOAs typically require, here's the thing. I live in a community that has an HOA. And I'm on a board of an HOA. So I understand HOAs and I understand what they cover. Each HOA is a little bit different in what they cover, so on and so forth. Now, depending on the HOA, a lot of times they'll cover maybe the structure of the property, the exterior, maybe they'll cover the sewer, but it's typically on the outside of the property, right? Anything from the exterior of the property to wherever it is, right? If there's a fence around it, if it's a PUD, then it changes. There's a lot of variations here. So somebody giving you a blanket statement that it's in an HOA, you don't need an inspection, is someone that needs to be educated on the entire process. But you're not doing an inspection for those things too. You're doing an inspection to check the water heater, to check the HVAC, to check the electrical, to check the plumbing, to check the interior of the property, which the HOA does not cover any of that. So, in some cases they don't cover the roof of the property. And, you just gotta, the electrical panel, any of that stuff. And these are high cost items that may come back and bite you, regardless of if you're getting a home warranty or not. So I would tell you, don't waive inspection contingencies in this case, unless you've seen a home inspection or unless you feel comfortable with the property based on some sort of inspection that, you've done and you have the expertise to know what you're looking at. Otherwise, I think you're I wouldn't say you're being misled, but I would tell you that the person that is telling you that isn't giving you accurate information.
And honestly, we joke, but I was my initial thought, and the reason why I wanted to get this question answered and get it in front of Jeb, if someone misses an obvious and easy one that badly, I wouldn't trust them. This is the biggest investment of your life, the largest leverage debt that you're going to take on. It's too important to risk it. A lot of times we get questions of, well, this person's going to rebate part of their commission, or I want the lowest rate. It's important to get competitive rates and fees, but it's way more important on this stuff to have an expert on your side.
No, absolutely. Yeah. I mean, I don't like telling people to find another agent because but when people say statements like that, it's one of those things that they obviously have no idea what the hell they're talking about. All right. Allison has a question here. Has there ever been, or do you think there will ever be, any type of programs for first-time investors? My husband and I just bought a primary residence in California, October of last year. So congrats on buying the property. I'm not aware of any first-time home buyer incentives for investors. I can't see that ever coming to light, especially in the world that we're in right now, where primary borrowers are having a difficult time finding property. But are you aware of anything there, Josh?
No, I would agree. And again, think of the reason why investment loans are harder to get, require bigger down payments and have higher terms. It's because there's greater risk. If someone owns 3 properties and hits hard times, the one they're going to let go are the investment properties. They're going to cling to their primary residence for the most part. And again, for the government to step in and incentivize investment in properties, like Jeb said, when we have a shortage of properties for people to buy, is not likely to happen.
Just like a tax credit in an environment like this is not, like, I would think is not likely to happen. But hell, I've been confused with everything going on with regards to a lot of the stimulus. So who knows? So I get this. I'm reading questions, guys.
Let me throw this one up here.
All
so
right,
how often is the case of one agent representing 2 clients on one property? So I'll let you start, Jeb, because you actually had this a while back.
In this market, a little more often than not, just because there's a lack of homes out there. It's actually happened to me a couple times now within the last month and a half, where I've had multiple property buyers looking at the same property. In one, I was showing 2 clients within half an hour of each other the same property. Actually, multiple properties that same day. We saw multiple properties that I saw with one client, then I saw with the other, and fortunately, neither of them wrote an offer on the same exact property, which is surprising. But I would say in the environment that we're in right now, it happens more often than it's ever happened in my entire career. I mean, I've had it happen, but not like this. And it's just because there's not a lot of property out there, right? So if somebody's looking in a certain zip code or a certain area for a property, chances are, if you're here in Southern California, there's only a handful. So if they want to see one, chances are they want to see the other.
Well, I will throw this out there, Jeb. A buddy of mine who's out in Arizona, also a busy market, and he does a ton of loans. He does 100, 150 more loans a year than I do. He put a Facebook post the other week that he had 3 clients that he had pre-approved, all right offers on the same property. It's a little less of a conflict for a loan officer, because all I'm doing is saying they're all awesome. I mean, if they ask me which one's the most qualified, I'm going to tell you, once I qualify them, they're all the same. They're all 3 going to close. But from an agent side, if you have 2 agents wanting to write, it's a little bit stickier on that, right? Because they're going to come back to you. The seller's going to go, well, which one will pay more, or which one's more solid? A little harder for you.
That's where the whole dual agency thing is tough. Representing more than one client, not even necessarily representing both sides, but representing more than one client on the same property. You've got to kind of take yourself out of the equation and provide them with information like you would anyone, and get information from the seller and provide them with that, and just kind of let them put their best foot forward in writing the offer or the number that they want to put out there, right? Us as agents aren't really supposed to be telling you, hey, this is where you need to write the offer. It's more of, hey, this is where things are going. This is where I could see, and giving you, experience and that sort of thing, and letting you ultimately make the decision on it. So yeah, no, a tough one out there at the moment for those that are kind of specific on what they're looking for, because chances are, your agent might be showing it to multiple people. Joey has another question here, another $5 super chat. I think Joey's up to like $25 in that. Joey, you're supporting the channel alone, bud. Thanks, man.
I'm gonna start calling Joey my 805 dealer.
Yeah, there you go, from New York. It just kind of all like the king of New York. Does Jay Powell's use of the word frothy today change the way you guys look at interest rates for the remainder of the year? So I'll let Josh answer here in just a second. But, typically what happens is, for me at least, Joey, is I don't read into what Powell says. I read the commentary on how people interpret what he said. People that are smarter than me kind of break down what he says and kind of give their interpretation of it. So, a change of the word like that doesn't change anything on my side. The idea was that the insight from the members of the Fed is that interest rates are still going to stay low through 2023, maybe even 2024 is the start of the rising rates at that time. So when they kind of confirm that, I take everything else out of the equation. But Josh, what are your thoughts on that?
So we have some risk over the next couple of months. We saw the big spike up in February and thought that it didn't make a lot of sense, but the markets were looking forward and were worried about higher CPI figures. We got a hot one for March. We're going to have another one for April, another one for May before it starts moderating in June. Last week, we went through the reasons why for that. So we saw some nice improvement over the last couple of weeks, and now we've kind of leveled out. The market's kind of deciding, do we continue to interest rates get better? Or are they likely to get worse? I don't think there's much risk of rates shooting a lot higher. For the next few months, I don't think there's a whole lot of hope for them to get better. We're going to stay in this range right here where we're at, which is pretty darn good. So if it makes sense for you to refi, or if you get an offer accepted, you just run with it. The rates are great. Do a low cost, no cost loan, and then be in a position to refinance when rates move lower. The biggest piece of this is, and I can't stress this enough, the federal government cannot have higher interest rates. They owe too much money. So come higher, hell or high water, they're going to manipulate and keep interest rates low. On top of that, all the academic research has shown that massive deficit spending leads to decreased growth moving forward, which leads to lower inflation, not higher inflation, and rates are likely, because of that, to continue to move lower. Since October of 1982, almost exactly Halloween of 1982, we have seen interest rates go nowhere but down. So for 40 years. Now, that doesn't mean that over a 2 or 3 or 4 or 6 or even 12-month period, they don't go up. But over the longer term, any 3 to 5 year period, rates have ended up lower, and we haven't seen the bottom of that. So Powell knows that. He knows that we're not going to see a big pickup in the economy. So we're going to see the stimulus work its way through. We're going to see the really low inflation numbers fall out from when COVID first jumped off, and we'll get through this. And at the end of the year, then we're going to kind of see realistically where we're at. But rates are going to stay low for a long, 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 long time.
There you go. Kalar, another super chat, $2. Thank you. Thank you for that. Is it best? Well, hold on. She asked 2 questions. No, is it best to cash out and reinvest? Josh, thoughts on that?
Only in Dogecoin.
Oh, Dogecoin, my enemy.
Your nemesis. My answer here is we need more information. Cash out and reinvest in what?
Right. No, for sure.
Powell using the word frothy. We do have a frothy stock market. That doesn't mean it can't go higher. It means, you better be very careful and experienced in what you're looking at and buying. If we say interest rates are really low, what the government is doing by that is forcing people into the stock market. So by long-term measures, the stock market looks really expensive, but can it go higher? It can go higher if there's nowhere else to put your money. We're just seeing a lot of interesting stuff. But my question would be, what are you going to reinvest in? Are you speculating or are you investing? And a lot of that comes down to your experience and skill level. I believe there's still lots of things, including real estate, that you can invest in. But if it's your first time investing, I would be really careful about taking cash out of my home to take my first effort in investing in something.
There you go. Couple things here. Jennifer posted a great comment. Have you hit the like button yet? It's painless. Ha ha. It's not funny. Hit that like button. Thank you. There's something else happening in the chat here that I want to address. So a lot of people are asking about VA loans and being referred to Jennifer Beeston's channel on VA being an expert. I can tell you, I don't watch Jennifer's channel. She might be an expert on VA, but if you have a VA question, just pose it in the chat right now. You got two people that know VA very, very well from all angles. So if you have a question on VA, post it. Happy to address it. Yeah, but check out her channel too. I don't have the link there, but it's somebody can post it if they want. I'm not against that. I don't care. It's all about sharing the wealth, educating you folks out there. But here we go.
And
Brian,
to close the loop on that,
yep.
I did about 50 VA loans last year. It's hands down the best loan program out there in terms of flexibility, low interest rate, low down payment. It is the best program. If you qualify VA, unless you also have the opportunity to put a down payment, a big down payment where you could avoid the VA funding fee, it's the most amazing program there is. The guidelines are not all that tricky, but the reason why Jennifer has done so well in that space is most loan officers aren't super experienced with it. Jennifer did, what was the number? Like 500 loans last year. It's an extraordinary amount of loans, and the majority of her business is VA. But yeah, Jeb and I do a lot of VA business. We've talked about our client here that did a 69% debt to income ratio purchase in Huntington Beach. So if you have VA questions, reach out. We know the guidelines backwards and forwards.
Yeah, no, and you can post them in here too. I mean, that stuff helps people. So don't just keep the knowledge to yourself, people. Brian has a question here. I think this is a good question for a lot of people because there's a lot of people looking to get into investing and buying houses at the moment. So two friends and I plan to purchase a duplex or multifamily soon to increase our chances of competing in Detroit's market instead of going at it alone. Any advice on the best way to finance it? Josh, multiple people on one loan. Is it possible? Anything tricky there that we need to consider?
Every loan program will allow us to put multiple borrowers. There's no prohibition against that. So what we want to look at here, the key part here is duplex or multifamily. With a duplex, if you're going on a conventional loan and doing it owner occupied, you're looking at 15% down. If you go FHA, it's 3.5% down. Now, if you have 2 or 3 buddies coming together and in a lower priced market like Detroit, and you can come up with 15 or 20% down, by all means, look at the conventional option. But the FHA can be a very good option. Now, a thing that hangs people up in Southern California and any other high-priced market with FHA, if you go to 3 to 4 units, FHA still allows them with 3.5% down, but they have something called a self-sufficiency test. We have to take all 4 units in the fourplex, add up their rents, and take 75% of that. It has to exceed the mortgage payment. Now, for high-cost areas, LA, Orange County, Bay Area, rents are high, but rents are not high, nearly as high as the absolute purchase price. So I haven't seen a 3 or 4 unit building in Orange and LA counties pass that self-sufficiency test in a long time. I know it does in other areas where prices are lower and rents are higher relative to the purchase prices. So those would be the things that I'm looking at. And again, Brian, if you want an expert, Jeb and I have people throughout the country. We can get you connected with someone who can help you in Michigan and pencil out the numbers. Let's talk about what type of property. Is it likely to be 1 to 2 units or 2 units, which is different than 3 to 4 units? And just run the numbers and see which option works better for you. Having multiple people on the loan is fine with conventional. It's fine with FHA.
Yeah, and they're still going to keep in mind, they're still going to use the lower of the borrower's credit scores, right? It's not going to change on that front. Combined incomes, they're going to take everybody's debt into consideration. So just make sure whoever you're purchasing with is solid all the way around. We got another super chat here from Joe Abra for $20. Thank you, Joe. I don't know. Do you have a question, Joe? Did I miss it? Did we address it? I don't think we addressed it. But if you have something, put it in there. I will address it for you if you have something. I'm working my way back up here. People, thank you for your patience. Here we go. Here's one of VA a little bit. So currently active duty military. Thank you for your service. Served a tour last year and preparing to transition out mid 2022. Are there any benefits I should take advantage of now that I'm currently still active on duty orders? Josh.
If we can still show active, then we can use your current military income. They will verify if you're coming to the end of your enlistment that you have re-enlisted. So now Jeb, you and I did one. It's been like 3 or 4 years now. The guy had just left the military and actually did not start the job until a week after we closed the loan. So you don't necessarily have to be on the job, but you do have to have a solid job offer that the employer will verify your start date, your salary, all that fun stuff. So nothing there really that I would say that you need to do that is different now versus while you're active duty versus once you're out. But just be aware that when you're making that transition, we either want to show that you're active duty and we have that income's going to continue, or that we know we have post-duty income coming into play that we can qualify you with.
Well, Josh, can't you, if you're active duty and you're receiving housing, you can gross up the BAH and the BAS and that sort of thing, so you can actually have more income as active duty, potentially, being grossed up than what you would normally report in some cases. So that may be able to benefit you, but you would have to, again, show active re-enlistment, right?
Yep.
Yeah.
So that would be the big issue with that. But it would also say, I mean, let's say you have $6,000 total monthly income while you're enlisted, including your housing allowance and your subsistence allowance. If you make $8,000 at your new job once you get out because of what you've learned and experienced in the military, well, that's probably going to be more. But if we gross it up and it comes out to $7,000 and you're going to make less than that, then obviously it would be more beneficial to do it before you're out. I talked to a veteran this morning. She's actually stationed over in Italy now. She got about 2 more years left and looking to get out. And we had this exact conversation. Do we do it now? Because her husband is with her in Italy, but he can come back here, get a job in Southern California. They can buy using his income, her income, and we just had this exact conversation. It really just comes down to penciling out the numbers and what you expect to make once you get out of the military.
No, and then here's another one from Francisco. So, are you still qualified for the VA after your term, or do you need to use the VA while on active duty? No, you don't need to use it while on active duty. There are certain requirements you have to meet while you're being a veteran, right? That you have to serve, a term. I don't remember the term, all the stuff right off the top of my head. You can contact Josh, myself, or somebody to get all that information, unless you can just rattle it off right now, Josh. But it sounds like you're probably, because you've served active duty, you're coming out, you're going to have VA benefits, if you're honorably discharged based on what you're saying there.
It comes down to length of service, and other than people who were just in for a very short period of time or dishonorably discharged, you're going to be eligible.
Right. All right. Let's see what we got here. So working our way out. Josh, see something? Get it.
No, let's see, Jeb. So you had asked there for the like and subscribe. I'm going to stop that share and I'm going to show what we've been working on that you've been mocking me because of my perfectionism that it takes too damn long. But the channel, the channel that Jeb says is never coming. It's here, and by next week we're going to have new, fresh content, not just questions that Jeb and I have answered here. But we've got 163 subscribers. We have 184 people viewing right now. If 10 or 12 or 15 of you could run over there and help boost our subscribers and get us going, we will be posting content 2 to 3 times a week here going forward.
There you go. So Josh, post that link in the comments there. Jennifer says, finally. Yeah, exactly. Finally.
Listen, people, I don't need any more pressure.
Yeah, there you go. So Willing 7 invested his entire life savings in Dogecoin and flew to the moon. He wants to know how to buy a house. Actually, if you're using Dogecoin, you can only buy a house on Mars. So you have to fly to Mars to do that. Yeah, how do you buy a house in this market? Well, first off, you need to cash out of the Dogecoin and pay taxes on that, and then see how much money you have left, and then we'll see where you are at the moment. Let's see here. Josh, hit us with a question, man.
Al had another one here. Are offers with jumbo loans more difficult to get accepted when competing against conventional offers? I wouldn't say so. I mean, because other than the fact that if you are in a jumbo price range and you're using jumbo financing and someone else is using conventional financing, it means they have a big down payment. So let's say in Southern California here, we're looking at $1.5 million purchase and someone puts 20% down, they're doing $1.2 million jumbo loan. To get down to that 822, 375 limit that we have for a conventional loan, that person's putting almost $700,000 down. That would be the only real difference there between the two of those, would be the size of the down payment. Jumbo loans can be a little bit more difficult and onerous in terms of the underwriting. I don't know. Jeb, you tell me, from a realtor's perspective, do you look at it and go, oh, this one's Fannie Mae and this one's going with jumbo financing, that would be less likely to close?
Not necessarily, but I will tell you, like right now, I have a listing and we're delayed a week on closing because it's non-QM. It's a non-QM loan, and it's not that the borrower is not qualified. It's just that these non-QM loans, the lenders take longer to sign off things, and it's not as streamlined of a process as with conventional FHA VA loans. So it's a different animal. And it was the stronger offer by far, so it wasn't really a concern of ours. They had plenty of money in the bank and all that good stuff. So it's just some things that you need to think about. I mean, I think if I had two offers side by side and one was jumbo, maybe non-QM, and the other one was not, I would probably go with the one that was not, if at all possible, just because I think it's a little more streamlined, and in that case, it would probably mean they have a higher down payment and all that good stuff too. So there would be more factors playing into it.
And from our perspective as a lender, that's my job, is to get on the phone, get that listing agent on the phone, if possible, if they'll pick up, and explain to them why our borrowers are incredibly well qualified. And by all means, they're taking it with a grain of salt. Every loan officer that's calling them up is not going to say, hey, my client sucks, you should take this offer. They're going to tell them how great they are. But it's still, it goes a long ways for us to be able to ask them, do you have any questions? Do your sellers have any questions? Any hot buttons that we can cover for you? And I will say, just honestly, 65% of those questions with conversations with listing agents go really well. Even if we don't get the property, we have a good conversation, get their questions answered, give them a comfort level. And 1 out of 3, you're just like, that's just bizarre that a listing agent seems irritated that you would call to offer information about the offer that they've received.
Yeah, no, crazy times. Caleb Conley gave a $4 or a $5 super chat. Thank you, Caleb, but followed up with a question here. So let's get to that. What are your thoughts regarding flipping a house versus using the house for cash flow? If this is my first property and I'm looking to grow my real estate portfolio, thanks. So Josh could talk about this a little bit, but my thoughts are, what are you going to do if you sell the property? Are you going to roll it into another property? And you're going to have to pay taxes on the gain of that. So something to keep in mind there. Cash flow is king. If we in a market right now expect that home prices are going to continue to rise for the foreseeable future, and I believe that, so I'm using myself as an example here, holding on to that property, collecting that cash flow while collecting the appreciation could be a solid way to get your investment career off the ground. Josh actually has a similar scenario right now that I think he could probably touch on with buying a property that he was potentially going to flip, but maybe keeping it as an investment. What are your thoughts on this, Josh?
Yeah, what Biden's talking about tonight is going to go a long ways towards it. If they massively increase capital gains taxes, it could change the calculus on that. But in California, a high tax state where anyone making any kind of income is at 9%. So let's say you're moderately, you're 6 figures on your taxable AGI for federal. For anyone in California, you're paying on the top end, the top dollars, 44% of that in taxes, 35 federal or 35 federal and 9% to the state. So if you add to your ordinary income, that's going to the top dollar, and you're going to pay a ton of it in taxes. So for us, we say, do we want to sell this property and realize some gain and give a bunch of it to the government? Or do we want to keep it at least a year where your top capital gains currently drops all the way down to 20%. So you're saving an additional 20% of whatever the gain is on that for now. And they're not going to get their crazy 40% or whatever they want, but it sure as heck could go up between now and next year. So it's something we'll be watching. And for us on that property, with the financing we would put on it, it'll break even. It's not going to make us money, but it'll break even. So it's not going to cost anything to carry it for the next year, and get to a more favorable tax treatment. And for us, we believe that property is going to go up, 5 to 15% between now and next year. And in that price range, you're talking another $35,000, $40,000, as well as saving $20,000, $30,000 in the tax bill. So what I will say is my biggest regret as an investor and as a flipper is that we were only flipping for income from 2008, 2009, 2010. Every one of those properties, if I had kept them, they would have cash flowed because we bought them at such good prices. The market was so low. They would have cash flowed immediately, even if we had done 100% financing. And if you look at Bigger Pockets, they have a whole playlist and video channel on, what do they call it, Jeb? It's the rehab repair.
A BRRRRRRRRRRRR.
Yes. So it basically get a distressed property, fix it up, buy rehab, refinance rent.
Yeah.
And it's a great strategy if you're in an area where the prices will support that. Like we were talking to the previous gentleman in Detroit, rents are higher relative to home prices. And if you're in one of those areas, a guy a vendor of ours that we do some stuff with, his other business is investing, and he's in Omaha, Nebraska, and his goal is to buy and acquire, renovate, and rent 100 properties. And once he gets to that point, he will have $80,000 a month of passive income. It's not passive. He has property managers. It's passive to him, but it's recurring income, and it's sheltered in a million ways relative to other types of income, at least with our tax code as it is currently written. So if you can acquire properties, get most of your money back out and still have them cash flow, I would do that as many times as possible.
Absolutely. And then hold those things forever. Gerald gave us $25. Gerald mentioned earlier that he was buying new construction and closing later in the year, but still touching base and staying in the chat. So thanks again, Gerald. Giving $25 to Josh so he can buy beer. That's fantastic. Josh likes beer, and
we had a very frustrating experience. We took the wives to Taco Tuesday last night at one of our favorite watering holes, and Jeb orders an 805. The two wives ordered an 805.
Hold on, change it. I ordered an 805. You ordered an 805. Then the two ladies ordered. So you were second in.
I was second in, and magically the ladies' 805s arrive. My 805 isn't there. She says, "Hey, we have a small problem. We got to change out the keg. We'll be right back with your 805. 10 minutes go by, no 805. And then she comes back, "Sir, I have bad news. We do not have a replacement 805 keg." So now I'm sitting at a table with 3 other people happily drinking 805, and I have nothing.
The way the cookie crumbles. Yeah. Anyhow, we'll get you one for the next show here. Some good questions coming in here.
Let me throw this one up here, Jeb.
Yep, there you go.
Rochelle Serrato says, "I own a duplex in California, paid in full, but they need work, electrical, roofs, etc. I have a difficult time deciding to refinance to remodel or just sell and buy a new home. Any advice, please?" I think most of the people here in this channel that are out in the market trying to win the bidding wars would tell you, if you like that property and you're happy living in it, refinance, get the money out and get it dialed in exactly the way you want it and stay there. But it really, neither of them is easy. Doing renovations to a property is not simple. Going through the refinance process.
Hold on,
and getting that cash out.
It's not like HGTV?
No, it's nothing like HGTV.
Come on. I thought you just remodel a kitchen for $5,000.
Yeah, I love the shows, but not realistic in timelines, budgets, quality of work. For a couple of those channels are based here in Southern California, and we have friends who have sold some of those properties that look beautiful on television, and yet when you see the property inspections and the things that go through, you go, wow, that person is a millionaire from flipping homes and has an HGTV channel show. But yeah, it's not quite as easy. But just there's a lot there to think in terms of, do you have it in you? Do you have good contacts in terms of contractors? Do you have somewhere to live? If it's a duplex, are you going to move the tenant out of the other side and do one side while you're living in it? I mean, the roof you don't need to move out, but if you're talking kitchens, baths, that type of stuff, you probably need to be out of the property for a while. So both of these can involve some headaches and hassles. I would not look at selling that duplex. Even if you wanted to buy, let's refinance it and get a chunk of money out so you can go put the down payment on the other home. I think in the long run, you'll regret selling a duplex if it's a nice property in a good area that you can keep tenants in at good rents.
Yeah, especially. And when selling a property that needs work, I mean, you're likely going to take a hit to some regard on that, right? I mean, maybe in this market, not as much, but buyers don't want to pay a premium for properties that need work. They typically see them as, as fixers and what have you. So if you're going to put it on the market, even if you're going to put it on the market, it might be worth your time to put some money into it, just so that buyers coming in don't think that it's a situation that they can offer much less than what you're asking. You got people here subscribing to the channel, Josh. So you got some
just refreshed, and we have 10 already. So I would say,
look at that.
Those people 10 actually, of you, I thank you greatly.
These people actually like you. That's amazing.
That's what my wife says.
Yeah, exactly. Let's see here. We got Saycat. Socket.
Should I go to Google and see how Google says to pronounce it? Or maybe there's a YouTube video on how to pronounce it.
We should. What was the name last week that we found and we did it? It was awesome. Josue. Is Josue here? Because we know how to pronounce your name now. In
we
Japanese
found a YouTube
too.
video that
we could do it in Japanese as well. Yeah. Should I wait till August, December time for a single family home? I would ask you what I ask every week when someone asks this question is, why? Why are you thinking of waiting? Are you thinking of waiting because you believe that home prices will be less between August and December? Or are you waiting because you feel like there's going to be more inventory to choose from during that time frame? What's going to change in your financial position to maybe make you more qualified? All of those things. But if typically that question is being asked because people think that home prices are going to come down, or going to be less during that time of year, or that time because of things changing in the market or what have you, I would say I'm pretty confident that home prices will be more this time next year than they are right now. But that is a time in the year, depending on where you are, you see some seasonal effects in the market. So, if you're in an area where it snows, it gets cold, things shut down per se, you could see a change in the market just in that, right? Less people looking, what have you, holidays going on, all of that. So maybe that puts less demand or less people out there looking. So that maybe gives you an opportunity. But I think if you're looking from the perspective of, you're going to be able to get something for less, I would tell you that's likely not the case, and that you should just continue your search now.
So Jeb, I have something fun. We're gonna share this here. Oh, crud. It might take too long, but I'm trying to find the YouTube video to pronounce that, and I found it. But I found, more importantly, it says, meet the executive director of Justice Democrats, Saycat Chakra Barti instead of Borti. But I thought we have actually a famous person in here asking questions, but we were one letter off on the spelling of the name. I thought everyone would appreciate that.
There you go. We had a question here just a moment ago that I wanted to pop up, Josh, and it was something we've talked about. It was talking about the Conquest loan. They were given. Oh, here we go. So JR had a question. Just heard from a lender today about Conquest loan. Can you talk a little bit more about this type of loan, please, Josh?
Well, you told someone to find a new realtor. I'm going to tell you to find a new lender, because either they don't know that UWM did away with their Conquest program, or they're still pitching it as a thing that that is beneficial. So Conquest was something that UWM was doing last year. United Wholesale Mortgage, Jeb did a couple of videos on some interesting programs that they threw out there last year. And what they were saying is, if you haven't done a loan in the last 18 months with us, we will give you better pricing. So there were a couple criteria that you had to be to meet to be eligible for a Conquest loan that had better pricing than their normal pricing. About a month or two ago, UWM went back and got rid of Conquest and replaced it with better pricing across the board, so that anyone that comes in will qualify for their best pricing versus just those who hadn't done a loan with them in the last 18 months.
All right, there you go. Got a question here, Josh, that I think is one that we should address. Do you have a brother named Luis? So Luis Lewis.
No, it's Lewis. His name is Lewis, not Luis. There's an O. It's Louis, Lewis.
No, Luis. Luis?
No, and I'm telling you, I don't have a brother named Luis, only a brother named Lewis. But I will tell you that in junior high, you guys will not find this hard to believe, but the young ladies who were trying to get my attention by irritating me would call me Jose Luis. So I also, you know, when I'm needing to demonstrate my mastery of the Spanish language, I will go by my Spanish name, Jose Luis.
Oh, there we go. This is fantastic. You should put something in, you know, for all you Spanish speakers out there, put a comment out here so Josh can translate it in Spanish. It'd be fantastic.
That'll be the highlight of the night.
Oh, that'd be awesome. Josh, you gents, Joey, you keep throwing money at us, man. Just ask a question. Don't keep throwing money. Do you gents offer consultation to people privately, even if you don't operate in their state region? Would love to pick your brain. So I would tell you to shoot us an email. You know, as long as you're not taking up like, you know, an exorbitant amount of time, I think we're probably happy to have a conversation.
Well, isn't Joey a member now? Isn't that part of Joey's membership?
It is. Yeah, we can do a live stream on something like that too, and answer some questions. So, and questions from you guys is what makes good content, because you know that's if you have the question, chances are somebody else does as well. Like this one, for example, Ruslan Malaraj. What is a jumbo loan, Josh?
Jumbo loan is any loan that is above the conforming limits. And you say, cool, what's a conforming limit? The conforming limit is the loan limits that are set by Fannie Mae and Freddie Mac. So in a standard area, this is funny, we're all the way into April. I'm supposed to have memorized this. 548, 250 in a standard balance area. In high cost areas like Southern California, Orange, LA, San Francisco, San Diego, we can go all the way to 822, 375. So in some areas, a loan as low as 600,000 would be a jumbo loan. For us in Southern California, you have to be at least $1 above that 822, 375. So anything $1 or more above the Fannie Mae, Freddie Mac limit for your area is going to fall under a jumbo loan.
All right, there you go. Demo Grevo. Yeah,
I'll bet you that means something in that language if we spoke it.
I hope it's Spanish, and you should know it.
Jose Luis should know it.
Currently under contract with a VA loan, what are the variables that determine the closing cost percentage? Google varies from 2 to 6% for closing cost.
The variable is going to be what lender you're with, from high cost to low cost. And then the second piece of it is what state you're in. Different states have higher or lower closing costs. For us in Southern California or California, it's a fairly low closing cost state. So we do all of our loans no lender fees. So say we did it 0.0 lender fees, and you're looking at a $500,000 purchase, between closing costs and prepaids, almost evenly split, you're going to look at somewhere between $6,000 and $7,000 in cost. So on a $500,000 purchase, for us, it's a little more than 1%. I'd tell you, count on 1.5, and it's going to be lower than that. Anything more than 2%, and that's just egregious. I don't care what state you're in or what lender you're dealing with. It should be less than 2%. And the other thing I always like to point out, both of the government loan programs. I don't know much about USDA because we don't have a lot of those in California, but FHA and VA loans have some of the largest potential lender credits. Like as an example, right now, our best qualified FHA and VA buyers are going to be getting 2.25%. If they're willing to go up to 2 5/8, so 3/8% higher, we can get enough closing costs in California. We get enough of a lender credit in California to cover all of their closing costs, all of their prepaids, combined with the zero down on a VA. They're coming in with nothing. And for a lot of people, it's a good route to go. So if you've saved $5, $6, $8, $10,000, I'd rather you have that in your pocket than go and get the absolute lowest interest rate.
I think that's good stuff to keep in mind if you're out there using VA. If you're still watching, 179 of you at the moment, hit the like button if you haven't already. Help us to get to 100. We're at 88 at the moment. Closing on Friday, FHA loan 393 loan amount at a 3.49 interest rate, and refinance is already on the brain. So how soon after should I wait for that Biden bill? So I'm not sure if you're talking about which Biden bill. I'm assuming, well, there's two things kind of going on here. One is you've got a potential tax credit, right? That if it goes into effect, is actually retroactive, right? So it's one that provides up to a $15,000 tax credit. So in your case, 393 purchase price, you would be maxed out at 15,000, assuming it's an FHA, so it's a primary residence, all that good stuff. You haven't owned a home in the last 3 years. You could qualify for that, assuming it passed, and it's retroactive back to January 1st of this year. So if you close today and it passed, you could still qualify and get that. Now, if you're talking about the second one, or the video I made today where we talked about the refinancing with lower credit scores that came from the FHFA, that'll be in effect in the summertime. So, depending on where your credit is, I mean, if you're getting a loan right now at 3.49 interest rate, not sure what your credit scores are, you might be in a position to potentially take advantage of that at that time. I don't know if there's any time limits on how long you have to have the loans and all that good stuff at the moment.
So most likely you're going to want to do an FHA streamline if you're in an FHA. With that, you're looking at 210 days after closing, and there's also a calculation from when your first payment gets made, but essentially 210 days, you're going to have that. So make your payments on time, maximize your credit score between now and then, and you're looking at somewhere December, January, being able to lower that a lot. If someone had a 650 credit score as of today, that should be mid twos, 275, right, 2.5, somewhere in that range. So it may be a situation of having locked when rates were a little bit higher, and or a credit score issue. But that 349 is pretty high for an FHA loan today.
Yeah, and I misspoke just a moment ago when I talked about the FHFA thing. That's actually for Fannie and Freddie. So you have an FHA loan, you wouldn't qualify to be able to refinance under that unless you were going from FHA to conventional at that point. So so hopefully that helps. I just saw a question from an old person on here that's been up here at the original days, and now I can't find it.
Don't call him an old person.
Well, not old.
While you're finding
a loyal subscriber, loyal person. Alex, I believe, was the name. Appreciate info, fellas. But he also asked a question, and now I can't find. Oh, here we go. Any cons to contacting seller agents directly? So when you say seller agents, I'm assuming you're talking listing agents. We've talked about this in other videos. Understand, we're in California. California allows dual agency, which means that the listing agent can represent both the buyer and the seller. Some markets don't allow that, or some states don't allow that. It's a gray area, right? I mean, the listing agent is hired on behalf of the seller. So, when somebody is hired on behalf of the seller, typically they kind of lean more towards representing the seller, more so than the buyer. Nothing completely against what you're thinking there, but just make sure if you do decide to go that route, that person has your best interest in mind as well, and not just looking out for the seller. Sometimes working with them hinders your ability to negotiate in some regards. So, just make sure you're doing your homework on that.
So I got a question here, and I'm going to put it up, then I'm going to take it down because we've complimented people on their beautiful profile pictures. Moist Girth does not have a beautiful profile picture. That is not in any way attractive. You should take another one if that's your best photo. So what's the purpose of mortgage insurance, and why does it go away with a 20% down payment? So
Good question.
Mortgage insurance.
I just want you to say the name again.
Moist Girth.
That is fantastic.
Is asking the purpose of mortgage insurance. In the past, before private mortgage insurance, lenders required you to put 20% down because that protected them against their loss or potential of loss if you don't make the payment and they have to foreclose. So after private mortgage insurance, a mortgage insurance company comes in and says, for mortgage insurance premiums paid monthly or sometimes other ways, we will insure that lender for you against the risk of loss. It goes away if you put 20% or more down because you're basically self-insuring with your own down payment. Less than that, you have to buy insurance to protect the lender against potential loss in the event of your default. And it's one of the things I always tell people, it kind of throws them off. If you put 15% down, you'll get a better interest rate than putting 20% down, because that 15% has mortgage insurance that covers up to a 25% of the loss on that, up to 25% of the loan, whereas the 20 is only 20%. So there's some quirks to it. You'll want someone that's familiar with mortgage insurance and knows how to structure it for you and to your best benefit. You still looking at this picture? You still looking at this profile picture?
I'm laughing at a comment that I'm going to post here in just a moment. But before I do that, Ray Campos, what do you guys think about taking equity out of a home here in Cali to buy a rental property out of state in Arizona and or Texas? So anybody pulling money out of a property, I would just tell you, if you're going to do that, make sure you're not putting yourself in a financial position where you're straining your financial position just to pull out cash to try to buy something else, right? If it's still affordable, it still meets your financial goals and all that good stuff, and you're not stretching yourself or putting yourself in a position where it's going to be tough, I don't think there's anything wrong with pulling equity out of your property to do something like this. But even with that said, if you're buying something in one of these other states, you've got to start considering, we've talked about this, the appreciation versus cash flow. And in a market like this, you might be able to get both. But I would tell you cash flow is one of those things that as markets pull back in home prices and what have you, if you're still receiving cash flow on that property, positive cash flow, you're going to worry less about what that property's worth. And I think if there's any reservation with regards to where home prices are going or headed over the next couple of years, I would go more for the cash flow side of things, because it's less emotional, less anxiousness in the future if something does change. But I don't think there's anything wrong with it as long as you're in a financial position to be able to cover that property if it doesn't get rented out. If something happens and that property is not rented, something changes, are you in a position to cover that payment every month? And if you are, and it's not going to put a strain on your primary, then go for it.
The big thing on that, Jeb, and looking at it is, generally when people ask that question, should I invest out of state? The subtext to that is, it's too expensive to invest in California. I can't do it, so I've looked at Arizona or Texas. Okay, so why did we look at Arizona or Texas?
Right.
Are those the same? Are those the same as each other? Are they the same as California? They're not. So Arizona is much more like California than Texas is, because their property tax rates are very similar. You have a very similar proximity to California, so you can drive over there in 4 or 5 hours, for the most part, if you want to look at that property, depending on where you are in California. And you have a lot of Californians leaving and going over there. The biggest difference between Arizona and California is they have a lot more undeveloped land, so you don't see the same amount of appreciation because it's not nearly as built out. Texas is a whole nother animal. The reason why they historically haven't seen the appreciation that we've seen in other parts of the country is because they place very large restrictions on the type of financing you can do once you own it. You can't take cash out of it. It's not super liquid. You can't easily take cash out of it. So it's not as liquid. You have really high homeowners insurance. You have really high property taxes. It eats into your gains. So all that being said, understand those markets, understand why they're different, understand what you're likely to get over time. And as Jeb said, the most important thing is cash flow. The people that I saw go broke in 2004, 2005, 2006 that thought they were investors that were investing out of California, as they were buying as many properties as they get their hands on, and most of them had little to no cash flow. So as soon as the market dipped, as soon as they had a vacancy, the properties just started going to foreclosure. So just be super careful. It can be a great idea. I'm looking at acquiring some cash flow investments outside of California, but it's not a simple and easy decision.
No, and with that, I mean, if you're only considering Arizona and Texas because you think they're good investment opportunities or good states and you don't have a tie to them for whatever reason, there's other places out there that you can buy property that cash flow even better than some of these areas in Arizona and Texas. And I'm happy to put you in touch with, I know some realtors in Fort Wayne, Indiana, and some other places across the country that are doing a lot of investment business right now with people from states like California, because the cash flow is crazy just because of the growth built around the city with jobs coming in and all of everything going on around there. So there are opportunities to maybe buy, and depending on what you're looking to pay for one, you might be able to buy a couple in some other areas. So anyway, we'll move on here. We'll address this quick question, and then I'll post the one that I was talking about. Will FHA Streamline get rid of PMI, Josh?
No, it will not. And the other thing, if we're sitting here, hey, we're about ready to close, and the thing that we have on our mind is refinancing. In 210 days, you are not likely to have enough equity to get rid of mortgage insurance, no matter what loan you go with. We just talked a second ago, where do we have to get? We have to get to 20% equity. With FHA, you're putting 3.5% down. It's possible, and if I remember correctly from your question a few weeks ago, it might be new construction, so it could have been under contract for a while. So it's absolutely possible, but just you'd want to know the only way we're going to get rid of that mortgage insurance is to get all the way to 20% down. But even if you had 10 or 15% equity in the property and a good credit score, a conventional loan can have lower mortgage insurance, significantly lower mortgage insurance than the FHA loan would.
All right. So Willing 7 mentioned Dogecoin earlier. So he says he used to eat seaweed for dinner. Now, since Doge propelled him to Mars, he's eating fish, drinking 805, and hoping the night off with Frosted Flakes. Tony Tiger Jib. Magical 8-ball Great Pyramids of Giza. There's a lot going on there.
I think he used the Dogecoin to buy some questionable substances. Exactly.
He snorted Dogecoin. I don't recommend doing that. It doesn't work well. I don't understand the appraisal waiver issue. Let's say list price is $500,000. I offer $550 with 20% down, which means a $440 loan amount. As long as the house appraises for $440, aren't we okay?
No. So 440 is your loan amount. So if it only appraised for 440 yes. and you were getting a 440 loan, you would have no down payment. So you in this instance, you'd be at 100% loan to value. So the question behind the question here is that your loan to value is not based off of what you agree to pay for the property. It's based off the lower of the contract price or the appraised value. So in this instance, if it appraised for 440, you would have to put a down payment based off of the 440. So you would pay the whole $110,000 from your 550 to the 440. You would pay that entire $110,000, and you would need to come up with a down payment on top of that.
Yeah. I keep reading these comments. I'm just laughing out loud over here. So Willing 7 is now admitting to being a fraud, saying Doge betrayed him, and he bailed, deciding to save his funds and for a house. He blames me. Fantastic. Yeah, I got betrayed as well. I look at it every day and think of my buddy and I that we talked about it at the same time, and I sat on my hands. I didn't sit on my. I tried to buy it, but I had to open a separate account, and I wasn't willing to do it. And now, just watching it go up every day. Anyway, I digress. Let's move along here. Juan thinks he's gay, so I'm gonna just put that up there.
Congratulations.
Yeah, he came out on our channel, so I thought I'd post that.
I believe it's now a protected class as well, so he had new rights.
There you go. Let's see here. Joe Abra give us a super chat earlier asking a good question here. Self-employed, can I make down payment from my business account?
The easy
Josh.
answer is yes, but there's some limitations there. Generally, you're going to have to prove to the underwriter that it's not going to cause a hardship for your business. So say down payment's 100,000, business has 100,000 in the bank, and you use it all. We need to be able to show, hey, why is it okay for this business not to have any money? Now, if that business has $1 million in the bank, you're going to write a letter of explanation stating that we do not need $1 million of free cash or retained earnings, and I'm going to take this 100,000 and buy the property. They used to ask for a CPA letter. Most CPAs will refuse to write the letter because they're basically preparing tax returns based off of the information you provided. They're not intimately aware of the details of your business and the functioning of your business, so most of them won't comment on whether taking the down payment out of business assets would cause a hardship for the business.
All right. Apple Sticks 1, been here before. Thank you for coming back and joining us. Hey guys, locked in a rate at 3.625 for a secondary home, and rates are going down. Would I be able to unlock my rate to get a lower rate? Josh, rates trend down. What can you do?
So it would largely depend on the lender. Do they have a float down policy, and how much has it moved? So basically, the lender is buying insurance against the risk of rates going higher when you lock a loan. So you need to understand that you're making a commitment to them. You're saying, I don't want rates to go higher. So if you make a commitment to me that I can lock this interest rate, I'm committing that I will accept that rate and close at it. Now, that being said, if you see a big decrease in interest rates, lenders don't want to lose their entire pipeline from people picking up their loan and going to a different lender that now has lower interest rates. So almost every lender has a float down policy. And what it amounts to is that rates need to move generally at least 0.25%, and they're not going to give you all of the benefit. There's usually a cost for the float down. So unless rates move 3/8 to 0.5%, you're unlikely to float down. And even if they did, you're not going to get the full benefit of it. So by all means, ask your lender, what is your float down policy? How does the pricing compare today to when we locked? And are we eligible to float down? The other option is to pick it up and go to another lender. But remember, you made a commitment to them to close at those terms, and they made a commitment to you to not charge you more if rates had gone up.
There you go. Josh, here you go.
Whoa. Yes. Sí. Por favor.
No, you got to read the question or the comment.
Jose Luis quiere tomar muchas cervezas.
There you go.
And they're like, that gringo should never speak Spanish again. Just stick to the plain English.
There you go. Nice work. He came in. He forgot we live in Southern California, man. Kind of side. We Spanglish.
No, it's funny. It's a little known fact. My wife, who is possibly the whitest person alive, I used to have a processor that she and Angie are really good friends about 15 years ago. And Angie started taking her to a place in the city of Orange where no one in there speaks English. They like you're in trouble. So now my wife goes there. You're just like, they look at you like, hey, dummy, I don't know what you're saying. So figure out how to say. So she would point to what she wanted on the menu. But now 15 years later, she goes in there by herself. She orders in Spanish because she knows how to say ceviche, por favor. And they make it for her, and it's absolutely fine.
All right, so here we go. Too funny. So Jennifer is posting paying money for Sam's comment that I was about to read. So I'm not sure how that works there. Jennifer, stop paying money, girl. Thanks for moderating the chat. That is appreciated. Let's see here. So Sam Hernandez. Maybe she didn't mean to post it. I don't know. My mom wants to help me and my brother in purchasing our first home. She has one property to help us with the down payment. See more. See more. Let's go back and see more. What is here? I'll go back to that question. What is the best approach in this situation? So my interpretation here, Josh, mom has a property. She wants to help kids buy a property. What does she do to what's the best way to make that happen?
So my problem here is I got a lot of questions. So mom's going to borrow from that house. Mom's going to sell you that house. Are you and your brother buying a house together or buying two homes separately? That would be my big questions there. So Samuel, if you're still here, pop in and answer those questions. Are you and your brother going to buy a house together, or are you each going to buy your own? And saying she has one property to help you, is she going to sell that and give you guys the money?
It's paid off for one. We do know. I know that now. Comment coming in. So answer the other question, Sam. We'll come back to it. How's that?
Okay.
Apple Sticks gave us a $10 for the super chat for the answering the question. Thanks for the advice. Wasn't sure what to do, and now I do. So thank you for that. That's awesome. Appreciate you being here. So we got a couple people asking for recommendations. There was one in Maryland here. There's another for Vegas or Nevada. Yes, we do have people in both of these states. I've referred people. In fact, in both of them, we have great lenders in both of those. So I will throw this up there while people ask a question here. You can email me. Actually, here, let's put this up here. I'll leave this at the bottom. Use that at the moment, and use that website and put that information in there, and I'll refer you out to someone that can help.
And the person that we're going to refer you to in Maryland is actually my own personal idol. She is an absolute machine. She is a lawyer. She has an MBA. She has kids, and she does like just an absurd amount of loans. And not the volume isn't the important part. She's really, really good at it. So we got you covered in Maryland with an excellent resource.
All right, here. Yeah. It's just so much going on here. So I will leave that going for the moment. And let's see.
So Samuel got back and got us the answer.
2 homes separately. Want to purchase our own homes. Looks like it's paid off. So got a paid off home. 2 homes. So it sounds like they want to purchase their own home separately.
Yeah.
What's the best way for her to facilitate this?
The 2 options: you can sell that property and you guys both get gift funds of half of the proceeds to purchase your own properties, or she can refinance that property and take money out of it. It just depends on what she wants to do. That property being free and clear, it's pretty easy to rent, low risk. You lose a tenant, no big deal. You just have your taxes and insurance to cover. So she may not want to take a loan against it, even if it were to cash flow, just because of the additional risk. The other option would be to sell. In essence, it's just an asset that is going to generate a gift to each of you to go and buy your own properties. The other option, if one or either of you wanted that property, you could take that property as your home and then do a 50% cash out refinance and give that money to your brother. So there's a number of ways to accomplish what you're wanting to do for both of you getting into properties. It really just depends on what she wants to do with that free and clear property, keep it or sell it. And then if either one of you would be interested in that property being your residence, because that would be sort of an easy button there. One of you guys move in there, do a cash out refinance to give the other brother half, and then they go buy a property with that.
All right. Good stuff. So we're coming up towards the end of the show here. Let's see. Let's get a couple more questions. If you're still watching, hit that like. If you find this information valuable, you like the content. Let's see here. So Lori just asked, rent or sell the little empty second house. Did we address something like that? But I would tell you,
no,
hey,
that's for Samuel.
Got you.
How to get. So you got a good question here for you, right, Jeb. Nick Butler says, had my offer accepted and the offer, we waived the inspection. We did, however, do an inspection. Minor things came up. Should we ask the seller to fix those things?
I say, yeah, absolutely. Yes, I just negotiated one where we actually said we were buying it as is. And we came back and negotiated. Termite was $1,300 worth, and then we got a $200 credit for some other miscellaneous items. So we basically told the seller we weren't going to ask for anything. I called the listing agent and said, "Hey, look, would your seller get offended if we did ask for something?" And he said, "No." So we asked for it, and they agreed to it. So I would tell you, the fact that you waived your inspection doesn't necessarily mean that you're buying the property as is. Doesn't mean you can't ask for anything. And again, the worst thing they can say is no. So, always ask and see what people are willing to do. I mean, you're in escrow at this point. You've got a little bit of leverage. Chances are they don't want to go back to the market, but just play it safe and not be too aggressive unless you're willing to lose it over something like that. Got some final questions coming in here.
Nick, I would be real careful about telling them, hey, our inspection turned up a couple things when you
Yeah.
waived the inspection. You might want to say, I noticed while I was going through the home. I wouldn't be super keen on someone who told me they were waiving their right to the inspection and that being a contingency for buying the property. But again, it's up to each individual seller. I'm just saying, I don't think I'd love that if someone waived an inspection and then said some things came up on the inspection that they did. By all means, we've talked about it ad nauseum here that you should do it regardless of whether you waived it or not, but just be careful.
Right. Yeah. So Minas Baini. Is it possible? Is it possible to buy a house without an agent? Yes. Yes. You can buy a house without an agent. Not recommended. I'll leave it at that. We've talked again in length about doing something like that. You need an agent to represent you in one way or the other, just to make sure things are being done properly. But to answer your question, the answer is yes. I wouldn't recommend it though. All right, guys, we are coming up on 2 hours. Appreciate you guys being here. Unfortunately, next Wednesday, we're not going to be live because I'm out of town for that week. I'll be in Arizona. Josh will be laid
you
up.
don't want to know what Josh is doing.
Yeah, Josh will be in bed. So we're gonna skip next week. Might do a live. If I do, it won't be announced. Just to come on and answer some questions. But appreciate you guys being here now. We'll be back the following week for sure. Appreciate the support. Appreciate all the comments, all the you guys being here constantly. It's a lot of the same people giving super chats, and I'm very grateful and appreciative for that. Josh, thank you for being here. Anything you want to add?
No, again, just keep the questions coming. Every week I go, well, what more questions could we have? But lots of good questions, and obviously you guys are finding it beneficial. We like answering them. It's knowing Cliff Clavin-esque facts about real estate and mortgage is only good if you have people to share it with.
There you go. Well said. So there's emails for both of us. Feel free to reach out if you need a lender, you need a mortgage professional anywhere in the United States. Send us an email. We'll connect you with someone that will take great care of you, that has the knowledge, the expertise, and the white glove service, to guide you in the right direction. So again, thanks for being here. Josh, were you going to add something?
I was just going to say I gained 15 subscribers. So Jeb, I am now only 37,592 behind you. So you better watch out.
There you go. He meant 27,000, but I'm
bad with that.
The numbers never lie, guys. Have a good night.